Hi, good evening, everyone. Many thanks again for joining on the call. Today, we wanted to take you through our first Fident Fineprint, which was released recently and got a lot of positive feedback from investors and the research fraternity alike. To quickly take you through what we have in store for today, I wanted to give everybody on call a quick update on the recent performance of our fund as well as a firm, the progress that we've made over the last 15 months. Followed by that, Mihir, who authored the report on the biotech CDMO and GLP-1 opportunity, will take you through a key summary and our insights on the same. Post which, Aishwarya will take you through a quick market outlook and how portfolios are positioned right now. That will be followed by a quick Q&A session where we'll be happy to take your feedback and queries. To begin with, quickly, to give you a quick update on the firm, and I'll try and keep this very brief so that we can spend more time on the research note as well as the market outlook. In terms of the firm update, the most important update I want to share with everybody is the current state of the organization and the people on board. To my mind, that's the most important thing to track and monitor as a platform. I'm pleased to share that now the Fident family and the Fident team is a group of 14 members. We, of course, have a group of 6 analysts, and they are working in tandem with Aishwarya. And a lot of their efforts in terms of research and portfolio construction, you will see in the subsequent slides. But I'm also equally pleased to share that in addition to the research team, we also have now the core team in presence across various key corporate functions. So be it products, investor relations, compliance, and other corporate functions. The key thing and the key message that we wanted to leave with you is that today we have spent the last 15 months in making sure the core team is in place so that processes are streamlined, operations are smooth, and client experience is top notch. And that is the key update that I want to leave at a firm level with all of you. I'll quickly skip over to the performance of our two core products. The first product, which is acronymed as FAIR, Fident All Cap India Resilient Portfolio. This is a flexi cap scheme, as some of you may be aware. And now we have more than 15 months of track record. FAIR was launched on 18th April 2024. And this is how across periods the performance of the fund has been. As you can see, for time frames, I know 15 months is not a long time frame, but I think it's important to highlight that this performance came in a period where volatility was significantly higher. So if you see across periods, 1 year since inception, the fund has done very well and delivered alpha of anywhere between 500 to 700 basis points, depending on the tenor. The other bit that I also wanted to share with investors, and this is what we track internally, is because the fund is a flexi cap category fund, it's also our endeavor to internally benchmark the performance against various peers. Because as investors, you will have the option to choose various funds. So we just wanted to share this. This is internal, but I wanted to share this with investors. So this is the relative rank of FAIR compared to the mutual funds in the flexi cap and the focused category. So if you see the flexi cap category, out of 40 funds on a 1 year basis, we are second ranked. And if you take the focused category, out of 28 funds, we are first ranked. So whether you look at relative to the benchmark or relative to peers across mutual fund, the fund has done very well over the last 15-month period. If I extend the comparison and look at PMSs also, and again, this is a peer set that we have defined of 50 odd funds. Again, you see FAIR featuring prominently and consistently in the first quartile. So this is how the first FlexiCap fund, which is FAIR, has done. The second product, which is our mid and small cap thematic portfolio, called Fiber, Fident India Builder Equity Portfolio. This is the performance of Fiber. And again, as you see across periods, the fund has added consistent alpha anywhere between 600 to 750 basis points, 6 to 7.5%, depending on the tenor. So that is the second scheme. Fiber, of course, stands for Fident India Builder Equity Portfolio. This portfolio is predominantly investing in mid and small caps because the themes that we've chosen, the 6 themes that we've chosen, are mid and small cap heavy. So that's the performance of fiber. We don't want to share, a comparative benchmark, but given the numbers, you can very well make out that again, fiber, just like fair, would be consistently featuring amongst the top deciles or the top quartiles, irrespective of the schemes you pick. So that is a quick update that I wanted to leave for the firm as well as the products. Quickly jumping over to the report, and as I said before I hand over to Raj, we've received a lot of positive feedback from investors, channel partners, and research analysts alike. And we would love to get your feedback on this note as well. What we wanted to do is, based on few requests and feedback from investors as well, take you through the key summary. The full note is also available on our LinkedIn handle, all our social media handles, and feel free to go through that report and also give us a shout out if you are unable to locate the same. With that, over to you, Mihir.
Yeah, hi. Good evening, and thank you all for joining the call. So first of all, I'd just like to give a brief overview of who I am. So I'm Mihir Damane. I'm an analyst at Fident AMC. I cover broadly three sectors: chemical, pharma, and auto. Before starting the presentation, I also want to set out some ground rules because pharmaceutical as a sector has a lot of jargons, and I'll try my best not to use a lot of jargon so that the session is both informative to everyone. Yeah. So before we go through pharma, I just wanted to put down what our philosophy at Fident. It's fairly simple. So what our philosophy is, what we like basically. What we like is three major points. So we like businesses that we understand. They are difficult to be disrupted and have favorable long-term prospects. In addition to that, of course, capital allocation is something which we are very, very cognizant about. Robust cash flows, and of course, we need to be, the businesses have to be run by competent management. And when you take both of those into account, you also need to have a favorable risk reward so that you can generate disproportionate returns to the benchmark. In a lot of sectors, when you go through and map out versus other sectors, pharma is one sector which kind of stands out because pharma, as broadly is combined of multiple subsegments. So whether it's domestic branded formulation, hospitals, diagnostics, CDMO, drug discovery, APIs, at any shape or form or at any tenure, you'll find reasonable valued opportunities with good tailwinds for a couple of years in pharma. I'm not sure how many other sectors you can speak that about. So when we are doing a deep dive into pharma sectors, we found three mega trends where we see disproportionately higher growth versus both the pharma benchmark and the total industry benchmark as a whole. And when I speak about mega trends, I'm speaking about not a 2-3 year mega trend. I'm talking about a decadal long mega trend. So with that, I think we'll move to biotech, which was the first mega trend which we really like. What is biotech? Biotech are basically innovator companies. Innovator companies, if I need to put it very simply, they manufacture new medicines for existing diseases. Innovator companies, whether it's lung cancer, whether it is HIV, there are a lot of diseases which are still yet to be cured by mankind, and a lot of pharmaceutical companies are actively focusing on those. Why biotech is an exciting business to be? So when you bifurcate companies or sectors, you will find most of the companies are either structural or cyclical, with very few sectors or companies having a disproportionate amount of growth on one event, and biotech falls in that. So whenever a new chemical, so a new molecule is commercialized, you can see uh, disproportionate amount of benefit which can flow through a company. I'll just give the case of Ozempic. I think a lot of people would have heard of Ozempic. So Ozempic is a molecule which was discovered by a company called Novo Nordisk. Not only that company changed the fortunes of Novo Nordisk, but it was single-handedly the key reason why Denmark did not go into recession. So when you put into account what one new drug can do to a company, forget about a company, it can change the entire economics of an entire country. I'll break it down into simpler version, how an economics of a new chemical entity or a new molecule flows. So a new molecule, small molecule, your cost can range anywhere from $1.5 to $2 billion. It can take anywhere from 12 to 15 years for you to develop, and your probability of success is anywhere between 1/5 to 1/6 of a yeah, molecule. Now let's go through the stages and what each stage kind of entails. Now I'm a biotech company. Let's say, how do I start? So let's say if I want to cure lung cancer, what I'll do is I'll identify 10 to 15,000 compounds which have the ability to kill the lung cancer virus. Uh, that will take me anywhere from 3 to 5 years. I'll From the 10,000 to 15,000 compounds, I'll reach around 200 to 250 compounds, which are the most promising ones. Then I reach the preclinical stage. A preclinical stage is basically uh, you test your molecules on animals. Primarily, rats are the main source, but you can use it for other animals as well, such as pigs. Once you kind of have done a preclinical test, and then if your molecule is kind of successful in that, you reach the clinical stage. A clinical stage is divided into three parts. You have stage one, stage two, and stage three. In simplicity, stage one, you have a lower amount of patients, anywhere from a single digit to a low double digit. Stage two, you have anywhere from 100 to 200, and stage three, you have a much larger sample size. This is very important because once your clinical stage three is cleared, your pathway to a commercial drug is fairly certain. Also, one thing which I kind of need to point out is stage two is the graveyard of all new molecules. Almost three-fourths of the molecules which reach clinical stage fail in stage two. So, if any molecule passes stage two, you have a great probability of that drug being commercialized. Now, I've given a broad overview of how a novel drug discovery or a biotech company functions. Let's go to where India stands in the entire scheme of things. Surprisingly, India being the pharmacy of the world, there is still only one NC in over three and a half decades, which has been innovated by an Indian company and has been approved by US FDA. That company is Orchid Pharma, and they have a molecule which is used for treating infections, UTI, and kidney. Sun Pharma, while they have a portfolio of NCEs, all of them are broadly acquired. They've not in-house developed any of the NCEs so far. Now you'll ask me here, oh, there's only one NC which has been innovated, 3 decades of R&D going. What's so exciting about the entire industry as such? And that's where the next slide kind of pops in. And I'll take a second for the audience to kind of have a look to see a lot of pipeline drugs and very exciting drugs which are in the pipeline for Indian companies. I specifically the recent or the most exciting drugs, and I'll take a brief moment to kind of explain with Wokhard. So Wokhard is the only company which has been, which is the second company I would say who has completed global phase 3. That means that actually by FY26 they'll get a US FDA approval, and by FY20 most likely it will become two by FY27. The second one is ISB 2001, the last molecule on Glenmark Pharma. So a couple of weeks back when we were writing the note, we got a reaffirmation of why we like the sector. So Glenmark Pharma has been trying to innovate a drug for over 3 decades. They got an interesting NC by the name of ISB 2001, and instead of developing it on their own, this out-licensed to AbbVie, who's a global cancer giant, and the commercials are mind-blowing. So what they got for out-licensing the asset is $700 million upfront payment, which is anywhere 5.5 to 6,000 crores. In addition to that, once the molecule progresses to future stages, they are eligible for around $1.225 billion. And whenever the drug commercializes, if it commercializes, that they have a double-digit tiered royalty payment. One molecule in stage one, it's not even cleared stage one at the moment, can give you such a large payoff. And that is extremely positive for the Indian innovator industry. And it's not that Indian pharma companies are not innovating. You see a lot of companies having different molecules at different stages. So these are the two major developments which I believe will result in a ripple off effect. And I think you'll see a lot of NCs coming in India over the next 5 to 10 years. Moving on to the next slide. Uh, I gave you a lot of gyan on NCs and why exciting business to be. Having said that, when you go to our portfolio positioning, we have very minimal exposure to biotech or NC based focused companies. And you'll ask me, Mir, why? And the answer is we like disproportionate reward. We do not like disproportionate risk. So three of the companies we briefly discussed, basically Orchid Pharma, Wockhardt, and Glenmark. If you just go and read the history, you'll understand the pain all these companies have faced. For context, Orchid Pharma, of course, was sold to Dhanuka Group, almost bankrupt. Glenmark had to sell off a lot of assets, including Glenmark Life Sciences, uh, to kind of reduce their debt because a lot of debt was taken in terms of research. Similarly, Wockhardt had to sell a lot of hospitals, a lot of domestic branded formulations to reach where they are. So while currently you might see a lot of gain, a lot of risk has been taken by all these three companies, which is why we are slightly skeptical of buying pure play biotech companies. We are not averse to buying them in the future, but at current moment, we have other opportunities where we see disproportionate reward without taking disproportionate risk. And that is where the second part of our section, which is CDMO, kind of pops in. I'll take a second to explain what a CDMO is. A CDMO is an organization which basically helps innovator companies, which was the first part of our section, for developing new drugs. So contract development is that, and then once the drug reaches commercial stage, you do a manufacturing for them. So that is contract development and manufacturing organization. Why this sector is kind of buzzing, has been buzzing for almost, I would say, half a decade or more, is earlier you saw the high cost of innovating a drug, and also the probability of failure for all those drugs. So what used to happen is a lot of molecules, once they cleared phase two, a lot of these innovator companies used to set up capacities for phase three, only to see the molecules fail in phase three, and that resulted in subpar ROCs for all these companies. So to be asset light, what they did was they kind of outsourced both a part of research and a large part of development to CDMO companies such as Syngene, Divi's, Lonza's of the world. And this is a trend which has been continuing for a very long time. And at least for the next decade or so, we'll see this trend to not reverse. In addition to that, while we only saw one commercial drug so far in biotech, CDMO is one segment which has seen reasonable amount of success. So if you take any of the top 5 CDMO companies in India, they would be catering to the top 15 to 20 global innovators. So whether it's a Merck, Pfizer, GSK, Zoetis, Eli Lilly, any of those companies, you'll see companies catering to them. So CDMO, why we like is basically it is a trifecta of strong tailwinds. You have strong innovator relationship, and you have a track record of delivering large sized molecules. If you move on to the next slide, you will see some of the large sized molecules which we kind of have listed. So whether it's a pyroxosulfone agri intermediate for Kumia Chemicals, which is around almost a 3,500 crore molecule, or whether it's Valsartan sacubitril, 1,000 crore molecule for TVs, or something like a very small molecule in the grand scheme of things, a darolutamide for Acuitas Chemicals, a 200 crore molecule, but changed the entire trajectory of the company. So our view on CDMO is we like a disproportionate payoff when a new drug commercialized, but we don't like the risk of failure because your ROCs goes for a toss. Innovator company can at any point in time only innovate 10, 20 molecules at a time. But something like a Laurus would have 90 to 110 projects in different stages of development. And when that kind of comes in, your probability of success is not linked to one or two key assets. It is linked to multiple assets, and that is where you can see great reward kind of popping in. We are extremely overweight on CDMO. We have four companies: Acutaas Chemicals, erstwhile known as Ami Organics. We own Laurus Labs. We own Syngene, and we own Cohance Life Science, which was earlier Suven Pharma. The thesis is fairly simple: attractive asymmetry, disproportionate growth at limited risk. And that has played out well in Acutaas Chemicals. And I would like Aishwarya Dadij, the CIO at Fident AMC, to kind of take you over what our thesis was, how that's kind of played out, and why CDMO companies are such an attractive companies to kind of bet on. Over to you, Aishwarya.
Thank you, Mihir. Good evening, everyone. I think Mihir has given a good insight on how we have clearly avoided, NCE or the biotech companies because there's a lot of investment and the risk reward is not very favorable. But whereas we have lapped up majority of the CDMO players, looking at the kind of growth that we were witnessing in majority of these companies over the last, I would say, 3 to 4 quarters. Just to give you an example, what the thought process we had, like suppose we invested into this stock when we started Fident was ME Organic, which is now called Aquitas Chemical. This company, when we started investing into this name, it was 600, 700 crore revenue. Primarily is into, intermediate, which is one of the element which goes for a pharma company's formulation. Now, the beautiful part is what when we look for CDMO companies compared to CMO. So CDMO is one who work with a large pharma innovator from the clinical stage. So it helps them to do a lot of research and the development part. Right from that, they have started working on it. So the kind of relationship that they developed over the years give a lot of these innovator a lot of trust and focus so that they give a lot of these businesses eventually when the product becomes successful. It's a very simple concept that you want to be with players who have been closely associated with the global innovators in simple terms. So that why did we like ME Organics, the current Aquitas Chemical, is that it was closely working with this company, which is basically Fermion, which when they were developing their product, which is the chemical called darolutamide, the brand is Nubeqa, and what we saw from 2019 till 2022-23, one after the other, they got the approvals to supply intermediate to them from the initial one intermediate to as high as four intermediate coming till 2023. And when this product got a lot of acceptance in the global market, Aquitas Chemical significantly gained on volumes in supplying intermediate to this player, right? And this is just one of the players which actually become very big. They at the same time work with many other innovators at different stages, and eventually one of them possibly will become the next say Nubeqa, which will drive their growth. So this is one very sweet space which we identified where the risk reward is very favorable, where we are able to see that growth kicking in, for these companies, and there is a kind of capabilities of R&D and competence. So if you see this particular product which Aquitas is supplying your intermediate to, in 2021 quarter one, this product was doing a revenue of almost 44 million euros. That number moved almost 12 times to almost 515 million euro in quarter one of 2025. So this drug, which was doing hardly a 200 million euro revenue in 21, has gone to almost $2 billion revenue. And most likely in the coming years, it will touch base to a revenue of 3 to 3.5 billion euro. So that is going to be a very big, kind of volume with which we are witnessing for Aquitas in the coming year. Even if you see historically, it has grown at a number of almost 40%, and with a very profitable growth of almost 80% and 100% year on year on EBITDA and PAT. And as I said, it is also working with many other players, including Takeda or Angeli, where possibly one of the drugs, if it become big, you want to see a growth for many years to come. So that is one of the reasons we identified to stay in CDMO companies rather than to biotech companies or companies which are very, very, risky in that nature. Now coming to the third segment, if you so like Mihir talked to you about this new discovery drug, which is biotech and then CDMO. If you see the third slide, the third point which we have covered in this presentation is GLP-1, which is glucagon-like peptide. I think everybody in this call have heard about Ozempic and Monjaro, right? I believe these are possibly right the stars of pharma space. I think I haven't heard at least 20 years of running investments so much of excitement about any pharma drug, even with very common people or in that parlance, right? So it has been taking a lot of interest and the right reasons, because this could be one of the biggest drug humankind has seen. So what exactly it is? GLP-1 is primarily used to treat type 2 diabetes, and the interest it has got is to do with it manages obesity, right? It takes care of managing the glucose level, reducing the debt, suppressing glucagon, and all the associated health issues which normally people faces. Now, just to give an example, this was what happened and why there is so much of excitement around this. That GLP-1 is not new. It has been around for a long period of time. There were basically two big molecules which were dictating the terms in this space. One is semaglutide, which is Novo Nordisk, the company which has this molecule. Another one is Eli Lilly's tirzepatide. So they are just simple two molecules which were at the innovator stage so far, and they were basically serving a very, very small market. Heading forward, majority of these two molecules are now going off patent and becoming generic in the coming year. And that's why the whole excitement is moving around. So if we just see, if I just take 1 minute over the last slide, this whole segment is currently around 53 billion USD market. Now, if I see that what has really changed, the two drugs which were in the innovator stage, which are moving to generics, have a very high efficacy of anywhere between 18% to 22%, compared to the existing drug whose efficacy, which was kind of a generic stage, was between 4 to 5%, and they were more in oral form. So that if I look at the number, the growth in this segment came from almost $7 billion to almost $53 billion as we speak. And most likely, this segment is to go close to around $100 billion of revenue across from these two products itself. Now, where is the opportunity and what is all excitement which market is harping about? So, see, basically, the excitement comes from the reason that these products are getting off patent and they are becoming generics, especially in countries like Canada, China, Brazil, and India in 2026. There is various other frontier market or under semi-regulated market, which are more than 100, where these products could be available at a generic level pricing. Now, how can any player play on this theme? So, what we had decided to cover in this report was that there's a three-way investors can look into it. One obviously is an opportunity for any Indian company, of course, because we're Indian base. One obviously that the market GLP-1 will have it in India, both from supply perspective, who will be creating the product for the Indian consumer. Second will be the GLP generics by the Indian pharmaceutical companies, which will be exported to these 100 or plus frontier markets or semi-regulated markets. And third, obviously, is the contract manufacturing, which is the CDMO in the GLP-1 space. We believe that when this market has opened up in India, there's a lot of excitement. If you go and talk to any of these pharma people, the biggest talking town is all about GLP-1 drugs. So when Monjaro came, which is a type 2 diabetes, it has a great success. In the month of June itself, it clocked almost 26 crore of revenue. And I'm telling you, this figure are the highest ever done by any drug in India so far, right? Similarly, Novo's drug, which is Vigo, has done almost, they have come out recently in July and they have come out with almost 2.5 crore number there. If I look at so we have to understand this, the difference here is the majority of this drug are injectables. The earlier drugs, we were more in oral solids, and we already had a market close to 400 crore. If we add this to drug which has come into the market from 400 crore to has gone to almost 700, 800 crore as we speak. In most likelihood, this market is going to be upward of 3,000 to 4,000, 5,000 crore in the coming couple of years. That is where the excitement is. And this is just India. Now, if you move ahead into the next slide, when I talked about same player who will be making and supplying to Indian market, who can also participate in the global semi-regulated or frontier growth engines of those geographies. Right, you have the same drug which will be supplied to India as well as this will be supplied to other countries. And if you can see the list of the companies in front of you, each one of them are working in some way or the other about of developing say drug and supplying either to India or any of this region. So this is one way of playing through GLP-1 generic market boom, which will happen in this coming years. But we have to understand this that a lot of these companies do a lot of other stuffs also. So GLP-1 could be a very small part of it, or they might not be really moving the needle around. So we have been closely watching this segment because we believe that the opportunity is huge, but it has to be very, very creative from that perspective. What the third segment is where you instead of doing formulation of this GLP, you become look out for businesses which do contract manufacturing. And as I said, there are two big innovators, Novo and Lilly. Novo basically don't outsource. They have bought a company inside and which supply them the API and the intermediate and do their CDMO work. Coming to Lilly, he's the one company which has outsourced his API and intermediate. And our assessment says that Divi's has announced a capex for a large GLP innovator, and we know there are only two innovators. So we don't know yet, but most likely it is Divi's which will be doing a lot of those CDMO work for Lilly in the coming times. So that is one opportunity there. Second is obviously, when you, as I said, majority of the drug which is coming is not in oral, it's not in a tablet form, it's more in injectable forms, and you need basically your fill finish capacities and pen. So pen is the injection and the ability to, any pharma companies to put that drug. And this is a very technical term, so it's not to be done. It needs a lot of capacity in R&D to do that. So there are certain companies which do that. If you see, there is one called OneSource, another one is a Gland Pharma. I remember they both have 40 million capacities of, fill finish capacities across, and they have invested heavily. Their capacities are going to 3 to 4 times in the coming years. And another one is obviously the device, which is called Pen, and there's Shelley Engineering, which is another one which has close to 35, 40 million capacities there. So these are some companies who possibly will benefit out of the whole big GLP noise that we are hearing through. Now, coming back to how we are going about it, where do we stand? We definitely believe GLP-1 is a long-term story with very strong tailwind. But similarly, like NCE, we have not invested into any one of them yet. We understand because there is a lot of excitement. There are some companies which have limited exposure that things is not moving the needle. Somewhere where we have comfort, the valuation is not in favor. And possibly, if might not know how many of you have seen, yesterday Novo has come out with the quarterly results and where they have cut down on the guidance, for the product because being this moving from innovator to of patent and getting into generics, stocks are going down. Stock went down almost 25% yesterday. So there's a lot which is happening in GLP-1. Obviously, we are very watchful of that space. And one way we invest, obviously, is to make sure that the risk reward is very, very favorable, right? So if we find some opportunity in CMO, CDMO space or in, pen or fill finishing or things like that, which play is a beautiful play on this thing, we will not hesitate. But as we speak, we don't have any investment which has any direct exposure to GLP-1. So what we have done so far is we have primarily stick to those safe way of creating money, which is CDMOs and CMO category or possibly CRO also through Syngene in our portfolios. So I think this is what the summary of what we believe to summarize. There are three very, very strong mega trends. One obviously is NC, another is CDMO, and third is the GLP-1. I would request one of you to go through the report so that you will be able to connect what we are trying to say and you will be able to appreciate the opportunity which is lying in the pharma space for Indian investors. Now, Coming forward, we will just spend a couple of minutes on how Fident is looking at the market going ahead. If you remember, we had done the last webinar on that was in January 2025, almost 6 months back. And the thesis we kept that time was that this year, 2025, will not be an easy year. This year will be a year of selection, and we had our own detailed discussion with many of you we had at the start of this year. Now, if you really look at how it has played out, if you see on the right-hand side, the global equity returns, India is one of the laggards in the equities return perspective, where majority of those European and US market or even China has given very handsome return upward of 20%. India has actually in the last 1 year given a negative return of 1.1. If I see different indicator, your even BSE 500 is either flattish to negative. Some sector has given positive return, like if I look at Bank Nifty is up 8% in the last 1 year, but it is not really moving the needle. Bank Nifty is large part of the Nifty indices, and just imagine if the Bank Nifty is up 8%, in spite of that, the Nifty 50 is down 1%, then the kind of pressure it has seen in various other sectors. So I think this thesis of ours has beautifully played out. And how do we see going ahead? One of the reasons for this underperformance of India's market has been, if I have to put it in just word, the issues are more local than global. It is our own wrongdoings, possibly, which is why we have not seen a very healthy market. Obviously, we had a huge base. Market has been phenomenally well for India for the last 3-4 years before 25. Valuations were not in favor, but the most important thing which really hinders it was the growth part. Right, so we're closely witnessing at Fident that the economic activity is showing sign of slowdown in the last say 3 quarters. When you look at auto sales, when you look at real estate sales, when you're looking at a lot of the industrial activity, we are seeing sign of sluggishness creeping in the economy. One of the biggest, I would say, red flag is the bank credit growth. We saw a number close to 9.3% in the fortnight last month. And I can tell you the bank credit growth and GDP are in sync. Majority of the global developed countries, the bank credit growth and GDP, the equation stand close to 1.4 to 1.5. In India, we are closer to 0.9. So if our bank credit goes down, obviously that leverage kind of growth takes a hit, and then that is what which is visible. Even if I see this, as I said, the industrial activity, if I see the last month we saw a number of 1.5% in IIP. Obviously it has to do with more to do with mining, but it is not setting a very good precedent among the way the economy is functioning. The biggest surprise I got was when RBI came out with that surprise 100 bips CRR cut from 4% to 3%. And at the same time, we have already seen a much larger cut on repo rate. From 6.5%, we came to almost 5.5%. Now, I remember, that when we heard the chairman and other people from RBI, the one thing which came to our understanding at Fident was that possibly RBI is trying to seeing something which possibly has not been factored by the market. That need to go so sharp on CRR cut and repo cut, rate cut, is possibly they were witnessing some kind of sluggishness or growth going down aggressively. So they wanted to make sure that it doesn't happen. And that was one very clear indication there. And then that data corroborated with the inflation we saw. The inflation this month, last month came to CPI came to almost 2.1. WPI was flattish. If you all remember in 2019, when we saw an early part of 2019, the inflation data started going down to almost 3.5%, 4% from the early 6%. And then we saw our economic GDP growth come to almost 4.5% in the fourth quarter. So inflation might indicate about the sluggishness which is there in the system. Some area which again were like private capex was definitely missing. One of the reason FI started selling India aggressively in the early part of the year and even in the late part of the last calendar year was because the elusive earnings which were missing, right? We only saw 5% growth in FY25. I think the expectation is close to 10 to 12, but I think 10% is what the street is expecting. And this is all the reason for market to remain like this. The volatility in the last 6 months has been unprecedented. And we obviously, this is in spite of a strong inflows in the mutual funds and SIPs and things like that. But how do we see things? Now, this is more like done and dusted. How do we believe things will play out in the coming times? We believe, this year will continue to remain a year of selection. You can't just spray money across and expect that you get to make wealth, sitting idly. Possibly it will not work. So when I see some of the green shoots which help us to make sure that we possibly are not going into the drain, the kind of sign that we are seeing in the rural side is very, very encouraging in the last, I would say, 3 or 4 quarters. The very good MSP prices, both Rabi and Kharif crop output has been very good. The wage growth is almost about of 5-6%. The infra spending by government is giving the much needed impetus. So growth from rural side is doing good. If I look at the economy from a services perspective, which is close to 60% or so, continue to grow at 7 to 8% kind of a number. So both rural as well as services will continue to push the economy. I want to also put out a point that the consumer sentiment, if I see monthly, has been in the range of 2 to 3%. And if you remember the budget where we saw our respected finance minister came out with a huge tax cut, that will start reflecting some demand in the coming, I would say, quarter, as well as we will see 8 pay commission. So urban demand, strong rural demand, strong services should support in GDP growth of 6.4, 6.5%. I think yesterday IMF came and revised India's GDP growth forwards upward from 6.2 to 6.4. What really excites me in the data which I am looking at is how the way the government is doing public expenditure. Right? If you remember, for the budget we were at a number of 11.2 lakh crore. You will be surprised to know in the last 6 months we have already crossed 7.6 lakh crore. With an average of almost 1.6, 1.7 lakh crore. So the run rate required is pretty low. So this much needed one side of this capex, I believe, continues, and we are doing more of a front-loading capex for FY26 rather than back-ended. One of the reasons which has really brought a lot of volatility in the market is obviously Donald Trump. We all don't want to discuss on that. We are all aware of it. But we believe that now that risk is more or less settled down. We see majority of the large global economies, whether it's Euro, Japan, we saw some of other countries like Indonesia are setting around the tariff. India is still in doldrum, but I think we will, after a lot of rhetorics, we will settle somewhere around 15, 18%. So I think that will not the best outcome, but then it is also not the worst outcome. And possibly the fear of world getting into recession is at our back end. Good things again, obviously, is we see a lot of good rains which are happening. Crude is at very, very comfortable positions. And I believe with the way inflation trajectory looking around, another rate cut, one more rate cut by RBI can't be ruled out. And we saw a very good transmission of 50 bips. So RBI has cut the rate by almost 100 bips. We already saw 50 bips going very strongly in transmitted, and the remaining 50 bips transmission will possibly happen in the coming time. So lower interest rate, good growth, I believe can give us, good opportunity with more stability of our macro going ahead. And that is also reflected in way our US 10-year and India 10-year hovering around 170, 180 is the differential. So I think India is in a good state now. We have gone past all of the negativity. We have seen everything possible from geopolitical to tariff and all of that. And we believe now it's time to see the growth coming forward over the next 3 to 4 quarters. But possibly the 1 or 2 quarters, we might continue to see some volatility here or there. So I think I will stop here with respecting time. And I mean, over to you on this.
Thanks so much, Aishwarya. Thanks, Mihir. Thanks for giving us a very brief and easy to understand summary on what is usually considered a very technical sector like pharma. We'll use the remaining time. We would love to get your feedback and questions, and we'll wait for a minute and feel free to put in your questions in the chat window. We would love to address them one by one. While we take questions, one request to all participants would be that we will try and stick to larger themes and queries around our products portfolios. We may not be able to do a lot of justice to stock specific queries, but we will try and cover them to the best of our ability. So the first question to Mihir and Aishwarya is, I think two names which come up, of course, on Acutaas. So the question on what are our views on other businesses like Baba Fine Chem, and what is our view on Newland with 3-4 molecules coming in FY26 onwards? Is this an opportunity according to us?
So I'll take Acutaas first. So we like three segments for me. So you have your intermediate business, which I think we will do reasonably well this year. You have the CDMO bit, and the third part is more on the semiconductor chemicals where they have like a 55-60% EBITDA margin. So recently they have come up with an announcement of putting around 200 crores of capex with a South Korean company to set up semiconductor manufacturing for one of the South Korean companies. And South Korea is a big hub for semiconductors. You have a couple of companies, couple of very large companies in South Korea over there. And we see reasonable advantages for Ami Organics. So Ami Organics, they acquired 55% stake in a company called Baba Chemicals some times back. And they used to supply to South Korean companies. So this announcement which they have done is not something out of the blue. They've been supplying as a contract manufacturer for those semiconductor companies for a while now. And I think this announcement will only bolster Ami Organics as a third growth lever. So we are very, very confident on all the three segments, whether it's semiconductor chemicals, whether it is battery chemicals for that matter, pharma intermediates and CDMO for Ami. On Newland and Blue Jet, I think there are a couple of questions which they have been asked. We at this point in time are more confident on our holdings. So we like Laurus better, we like Syngene better at this point in time. While we appreciate Newland's abilities and where they stand in terms of solid peptides, at this point in time, I probably would not want to give a lot more insight on Newland as a company. I would like to stick to our portfolio companies at this point in time. It's a company which we like the management, we don't like the valuation. That's all I have to say in brief.
Thanks, Mir. One interesting query is we are seeing the government trying to reduce healthcare cost and make healthcare affordable and opening up these Jan Ayushadi centers and kendras. What do we see that impacting our portfolio companies and the space in general?
Yeah, I got this. So we actually hold one company which is a key beneficiary of those. So we own Villas Biotech. It's a contract manufacturer for domestic pharma companies, and we also have a very thriving, I would say, stage to something like a trade chain of gone through the roof. It's down. I would say it's come down to 10 to 12% versus historically it was growing at 30-35%. So while there are limited risk to branded, so there are 3 to 4 companies who done very good work. So the Pharma, LKM, Cipla, and companies like Villas, which we currently own, they are the key beneficiaries of this. So broadly, net, I would say we might see 50 to 100 basis point impact on India. Having said that, in our companies, I think we'll more likely ride the tailwinds trying from that through our holdings in Villas Biotech.
Thanks, Mir. Couple of other names coming in, names like Vidlas Biotech and Venus Remedies. If we are comfortable, maybe we can keep, put across a one-line view.
Sorry, I probably would not want to comment anything on Venus Remedies just because I haven't had a thorough look at it. While I can give a one line answer, I don't think so it will do justice to the participant question.
Sure. And again, feel free to put in questions. Like I said at the start, if there are stock specific questions which we can't do justice to, given the paucity of time, we would love to interact one-on-one separately post the call and address the queries. One question on Laurus, in trying to elaborate which molecule we expect to drive volumes and which we think will drive earnings and volumes.
So we would like to stick to. So there are a couple of molecules which Laurus has kind of announced over the last 6 months, and they'll be going online this year. So they have a large animal pharma product which has gone online this year. Peak revenues around 600 crores. Or they also have an agri molecule which we presume could be anywhere from 300 to 400 crore opportunity, which will pop in. I would assume FY27. So these are the two molecules which are there. I think these are the ones which are in public domain. There are a few other molecules if you just browse through the export data, which I would assume is fairly easy to kind of access. You'll see smaller molecules in stage 1, stage 2, stage 3, which kind of pop in the next couple of years. But these are the two which has been announced by the company, which I would also assume are going to drive earnings for both FY26 and FY27.
Thanks, Mir. Another very interesting question on broad themes and segments, and our view on CRO as a space. How do we rank it relative to CDMO, and what are our thoughts there?
We like CRO. The problem with CRO is there are not a lot of pure play CRO companies, and we've not seen any beneficial advantage of only being in CRO currently. So while we own Syngene, which has almost, I would assume, anywhere from 60 to 65% of revenues coming from CRO segment, I would rank both CRO and CDMO companies on par. I wouldn't differentiate between the two. If a company has CRO, nothing like it. Though I would not rate it about CDMO at this point in time.
And just to add, a lot of these companies are trying to interchange into the roles. We have seen CRO player trying to get into the manufacturing and development, and same goes the other way around. So, like what Mir said, there is not a pure play player across the space, and Syngene, I believe, is the only one closest to being a clear-cut CRO player, if we define that thing, and we are holding CRO, just to put a clear disclaimer here in the portfolio.
Thanks so much, Aishwarya. Again, I'm trying to do justice to as many questions as I can and try and test Aishwarya, Mihir, and keep throwing names at them. So another query on Acom's drugs, which is relative to its peers underperforming. Any views we want to share, or would you want to take this offline?
It's the same. So there are three CMOs. You have Akums, you have Vendas, and the problem with Akums is the growth is relatively slower than the other companies. And it's also the largest player by a mile. So the growth threshold which it has, it's already reached kind of. It's almost like a mature company at this point in time. So unless it can find out newer ways to accelerate growth to where the other companies are growing, I would still prefer Vendas over this company at this point in time. So, and it's not that there's a lot of valuation arbitrage in holding Akums versus other CMOs. So at this point in time, that would possibly be one of the reasons why Akums is not being favored versus something like Windlass or other CMOs.
Just to add, like when we wanted to think about adding one CMO player, we had done this comparison between Windlass, Acom, and Innova across the space, and the comfort that we had get on the growth part in Windlass was much higher compared to the other numbers, given relatively much comparable valuation framework. So we went ahead and didn't see too much of growth coming in Akum, and possibly that might be one of the reasons stock is not getting that kind of response compared to other CDMO and CMO players.
Thanks so much, Aishwarya. Maybe I'll direct the next one to you as well. And a great question on how we are approaching investment processes, and as a fund house, what have we done differently from the rest of the field, which has led to a good outcome so far. So maybe you would want to take that, Aishwarya.
Yeah, so I hope it's just not only to pharma as a space, it's across the spectrum, right?
Absolutely.
So I tell you, we completed 15 months, and when we started, the valuations of the market and all of these mid and small cap companies which were showing huge growth, we don't had too much of play around comfort around valuation. So we were very close-fisted for paying out businesses. If the valuations were not comfortable, we didn't take that leap of faith in getting into those companies. Right to say, when we just to give example, since we are doing this pharma as a space, when we identified opportunity in Amy or in Laurus, we were seeing that the growth was setting beautifully in conjunction with the valuations, given the market was at the peak or the highest level since we started, right? So that is one differentiation which we have implemented here, that we should always have something on the table from valuation perspective when we are buying these businesses, and that has really played out well for us both in large cap space as well as in the mid and small cap space. Some names like which really worked well for us, whether it was BSE or Lotus Lab and all that, we were able to see a lot of growth which would play out since we invested into that, and we played on that growth and gave that a relatively, I would say, milder valuation, and that has added to our alpha across the fund.
Thanks so much, Aishwarya. Also wanted to just drop in a line. We've posted the email address of our investor relations team. Please, for any questions that we are unable to attend now, or any follow-on queries, feel free to send an email out to investorrelations@fident.in, or drop in a message on our LinkedIn page for either of us, and we would love to come back to you and address the query in detail. We'll just go on with a couple more questions. Uh, and I think I'm taking the last one. It's a very interesting one. The question is, how does the research process start when we come across any new company in the CDMO space? Of course, information is scarcely available. So how do we go about it? Maybe Aishwarya, you would want to take that.
Yeah, I think it should for Meher. Meher do a lot of work in researching on these companies. But I tell you, just before Meher answers, when we invest into these companies, we want to make sure that we have cross-checked the data from various perspectives. So, say in the case of Laurus, just not what the management is speaking through, what export data is talking about, what other competitors are talking about, how molecule sales are piling up, and whether all of them are putting in sync. And we waited for the data for at least a couple of months to just see whether it is rightly playing out or is it more of kind of a hoax. And then we on top of it, we do on our channel check, which is primarily visiting the plants, getting and whatever feedback that we can get from other pharma intermediary or other pharma expert, and try to connect the dots and then take that call on that company. So there's a lot which goes on into buying these businesses. There's one thing I want to tell you, that whatever we have bought so far, just to give example, pharma, we've been able to hold on in spite of a lot of these stocks there's more of 70, 80 or 100%. It is because of our conviction about those molecule and the data which we are getting, and the thesis which we played out is actually seeing quarter after quarter, month after month. So May you want to add anything more onto this?
Yeah, so I'll just give like a brief thought through about how we approach the pharma segment. So let's say if you take a pharma segment, the first thing you need to do is bifurcate into sub-segments. So all API companies in one, all formulation companies in one, all export generics in one, CDMO in one. Once you do that, you have to try to figure out what are the base source materials which you have access to. So of course we have access to IQVIA data. IQVIA data broadly tracks all domestic branded formulations companies. So almost top 40 companies, you'll see month-on-month growth or a quarter-on-quarter growth, which kind of helps in analyzing how domestic branded companies are doing. Second, we have access to export data through portals like Vulsa, which helps you access both CDMO companies export to innovators, where you can also identify molecules there. It also helps you access something like what Sun Pharma exports through India. These two primary data are thereabout. Then once you identify, for say like a darolutamide, which was announced by AMI, what you can do is you can go to innovators presentation. We put a brief here in our presentation here, and when you go to Bayer, who was the I would say the co-innovator with Fermion, you can identify the end user molecules growth. When you triangulate all three of these along with your internal research and collaborate with the management, and the valuations are favorable, then you go ahead and buy the company. So this is a brief of how we go about it. I can probably speak an hour on this, but I think the paucity of time, these are three external sources which we rely on to help us increase our conviction on pharma companies.
Thanks so much, Mihir. Again, I'm in addition to the investor relations email ID, I am also on the chat window posting the link to the report which we have summarized and discussed on call, the first edition of Fident Fineprint. Feel free to access that. And again, like I said, would love to get your feedback and queries. Feel free to either post them on the LinkedIn channel or reach out to the investor relations ID, and we would love to follow up and address that question in detail. So I know we are out of time, but we'll try and do justice to as many questions as we can, and appreciate the constant questions and feedback coming in. Maybe we'll take one last one, and this is on generics. We are seeing a few concerns among patients in tier 1, tier 2 locations, and the concerns are not really highlighted here, but Mihir,
Yeah, so I think yeah, so I think I broadly got the question. So broadly, the concerns range whether the quality of trade generics are equivalent to branded generics or not. I would say these are comparable medicines. I wouldn't say that they are exact replacements, because your compliance cost is much lower, your other costs are much lower. What gives us the confidence that trade generics will continue to grow is if you look at a country, any developed, I would not say any developed, but any emerging country where you have a large branded generic portfolio. India currently, I think it's only 10 to 12% of the overall portfolio. In addition to that, if you look at something like a Russia, very equivalent, they have, or a China for that matter, the trade generics have reached or penetrated almost 30% of the total overall portfolio, and that is what the government is also kind of pushing. And a very simple way to track is just tracking how the trade generic segment is doing. You can check the Jan Aushadhi revenues. They've been increasing anywhere from 25 to 30% year on year. Also, what you can do is you can just look at few of the larger companies. So something like Cipla, something like Alchem, who are large trade generic players. If you just track the trade generic numbers, you'll get a broad sense of how the market is doing. So the data doesn't lie as long as the data is very strong. I do not see why any challenges to those. And what is most likely to happen is you'll see all the low quality manufacturers kind of winning out, and all the generic companies, branded generic companies, starting their own trade generics, and that will kind of take care of quality. It's an evolving process, but I do not see any headwinds to growth at this point in time.
Thanks, Mir. And I think with that, we are out of time and most likely out of questions as well. But like I said earlier, on the chat window, I've posted the LinkedIn link where the fine print report can be accessed. either by posting replies and queries on that channel or by reaching out on email to our investor relations ID. Please do share feedback and queries, and we would love to get back to you with our responses and interact further. Thanks so much, everyone, for joining on call. Really appreciate you taking the time. Look forward to continuing this dialogue and getting your feedback over email and social media. Thank you so much. Bye bye.
Thank you. Thank you so much, everyone. We will conclude the call now.